Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Hello everyone. I know it's a little bit weird when you are not here and facing the empty theater, but I wish every good luck with what you are doing now. I'm going to deliver this lecture and you have to listen to the recording. I'm sorry for the lecture happens in this way, but I hope you can still catch up later after your exams. All right. So today we are going to do the lecture 7. This is the introduction lecture to the business combination and consolidation issues. So basically this lecture involves 2 chapters. One is the chapter 25 about the business combination. We discuss what would be the business combination, or it might be just the purchase of assets, right? And there are several things involved in the combination. And if the business have combination, how do we deal with them in accounting? Then we will discuss the very first chapter for consolidation issues. And it starts with the controlled entities, which is the chapter 26. So the issues, the topics included in this lecture, including the introduction to business combination. And when we discuss business combination here, we discuss the concept of control. When one party obtained control over another parties, we will have the business combination. That's why we have to discuss the concept of control. Then once the business combined, we will use some method to account for this business combination, which is the acquisition method. Then we will discuss just briefly in this lecture about the subsequent adjustment to the initial accounting for business combination, which will be intensively discussed in the following lectures in more details. And then we have the consolidation issues. Consolidation would be the most complicated issues you have in this course. But again, like I said, just follow step by step. You will be there. Don't worry too much. The business combination. What is a business combination? This standard number 3 is really about the business combination. The business combination is defined as a transaction or other events in which an acquirer obtains control of one or more businesses. So here there are a couple of keywords. The transaction obtains control. Without the control, that's not business combination. And one or more of the businesses. If you just simply obtain controls of assets, that's not the business combination. Okay? If that's nobody obtain controls, that's not business combination. So basically, the business is an integrated set of activities and assets rather than just a group of assets, right? And this business is capable of being conducted or managed to provide a return in a form in different forms, like the forms of dividends, the lower costs, or any other economic benefits. So if you may ask, so this is about the business combination. How about if I just acquire a group of assets? If that's the case, how do we deal with that? You probably will remember what we have learned in Standard 116. That is about PPE, right? So if you simply purchase a group of assets, then that's just simply the PPE standards. You purchase something, you record anything, then that will be what you have learned, right? So this chapter is different from previous ones. This is about the business combination. It's not just simply purchasing a group of assets, all right? And the transaction happens, then give rise to a business combination. And this combination could be taken in various forms. In this course, we discussed two forms of them. One is called direct acquisition. Another one is indirect acquisition. Direct acquisition is very simple. So basically, the acquirer, during this acquisition, the acquirer purchases assets and any possibly assumed liabilities of the acquiree. The acquirer recognizes the assets and liability acquired in its own account. And the acquiree will just recognize the receipt of the acquisition consideration. You know, when we have acquisition, it involves two parties. One is the acquirer, another one is acquiree. So for the acquirer, they recognize the assets and liability in their own account, and the acquiree would recognize the receipt from what the acquirer provided. The terminology we call would be here, consideration. So when you see the words consideration in our combination settings, that's what the acquirer has to pay to the acquirees. Okay? So in exchange of the net assets, then the acquiree, the one who has been targeted, who has been acquired, will liquidate their business. So basically, one party seizes their operation. Another party will take over whatever this one seized. Then they will keep running the business. This is direct acquisition. That's very simple because you wouldn't have much subsequent adjustment, and because another party, another business just ended their operation. So that would be simple. Another one is called indirect acquisition. This indirect acquisition is a little bit complicated because one party acquires one business acquires another business, but the other business still keep running as its own. All right. So this acquisition, the acquirer purchases the sufficient shares in the acquiree. They don't necessarily take over all their assets and liabilities. Instead, they purchase their shares. Then they obtain the control of these acquirees. The acquirer then would recognize an investment. Instead of recognizing all the assets and liability in the direct acquisition, they recognize the investment assets, which is equal to the consideration transferred. Now you know what is consideration, right? Consideration is just what the acquirer offered to the acquiree to obtain their share, okay? And the acquiree doesn't need to recognize anything, and they will just continue to operate under the control of the acquirer. So they operate as their own business as they have been operating. They don't cease their operation and they don't need to recognize things. Then for the acquirer, they will need to provide the consolidated financial statement. The consolidated financial statement they will need to have because the acquirer, they are running as their own business. In addition to that, they also have the shares in the acquiree, right? So to reflect the whole economic benefits for the acquirer, they will have to include the performance from the acquiree, right? That's why we will have the consolidated financial statements. All right. So we will discuss more. Actually, all the following lectures, we will discuss all about the consolidated financial statement. All right. So again, when you come back here, when we discuss business combination, come back to the concept of the combination, we do see the control here, right? That is the concept of control. So we will spend a couple of minutes discuss the control, because without the control, there is no such business combination. So the control is defined in another standard, which is specifically for consolidated financial statements. So when the investor controls an investee, an investor controls the investee when the investor is exposed or has right to variable returns from this involvement with the investee and has the ability to affect those returns through its power over the investee. It might look a little bit complicated. However, I will not require you to memorize the definition exactly as it's shown here. I will just ask you to remember the three elements. One is the power over the investee. So the investor would have the power over the investee. Then the investor will be exposed to variable returns, or they have the right to variable returns from this involvement. Then they will have the ability to affect these returns. Is that okay? So three elements: power over the investee, they are exposed to variable returns, and they have the ability to affect the amount of the returns. We are going to discuss each of the elements in more details in a second. Okay, so we discussed two types of combination, indirect and direct, right? So even though the same definition for this control is applicable to both forms of the business combination, it does not really make sense in the case of direct acquisition, because in direct acquisition, the investee will just liquidate. And the following of the discussion of the concept is mainly applicable to the indirect acquisition. And our chapter, actually our consolidation issues focus mostly on the indirect acquisition too. But actually, again, those concepts are applicable to the direct acquisition too, right? So what is the power over investee? The power over investee is actually the existing right that gave the current ability to direct the relevant activities. This is the definition for the power. So there are three key concepts here: existing rights and the current ability to direct what? The relevant activities. So what could be those rights? Those rights would arise from, most of the rights would arise from the legal contract. The examples are given in the standards. So the typical ones would be the voting rights. And they have the rights to appoint, reassign, or remove members of the investee's key management personnel. And the rights could also include the rights to appoint or remove another entity that participates in management decisions. And those rights could be the rights to direct the investee to enter into or veto any changes to transactions that affect the returns. So the power arises from such existing rights. And they will have for the first one, basically the voting rights would be the most important existing rights. So how do we have the voting rights? So that we have the power to direct, we have the power to control the business, to direct the relevant activities. So those powers, normally when we have the control over half of the voting rights, we would believe the power would be there. So the power is assumed to exist when the investor owns, directly or indirectly, more than half of the voting rights of an entity. Unless there is evidence to the contrary. Maybe you have more than the voting right, half of the voting rights, but there are some other conditions to invalidate your voting rights, then that will be the contrary evidence, then probably don't hold the control. But normally, we would just assume more than half of the voting rights gives you the power. So most likely, when you have more than 50% of the voting right, you would have the power. However, sometimes you may have less than 50. Let's say you may have 40% of the voting right. So your say may not be the major voice. In that case, in voting rights, so you may think, okay, then I don't have the power to direct the business to do whatever I want them to do. However, even in the case you have less than half, you maybe also have the power. Why it's not moving? Sorry, let me see. Okay. What happened? Just be patient. What's wrong with my tablet? Okay, so even you have less than 40%, less than 50%, you may also have the control, it depending on the other factors. So the other factors need to be considered when assessing whether there is power in cases when the investor holds less than 50%. So what could be the other factors that give you the rights, but when you still have the voting rights less than 50%? For example, attendance at the AGM. Do you know what is the AGM? That's the annual general meetings. So, you know, every company, they would hold the annual meetings every year for the big companies, and they encourage the shareholders to come to vote. However, if not every shareholder participate in those meetings, let's say only 60% of the votes of the shareholders representing the votes come to the meeting, then maybe you don't need 50%. You only, if 60%, you will only need 31%. Then you can get the votes. You can have your say. If you can have 31% of the voting rights and only 60% voting rights attended the conferences, then basically whatever you say will matter, right? So in this case, attendance at AGM will matter, okay? If you are not anticipating the full attendance from all the shareholders, then you don't necessarily have to hold more than 50 to have your say, all right? And another factor might be about the dispersion of other shareholders. So probably you have only 30%, let's say you have only 30% of the voting rights. However, all the other shareholders, the biggest shareholders rather than you, will only hold 5%. And the third largest one only hold 3%. So there is a big dispersion of other shareholders. They are less likely to vote together, then your 30% will give you the power to control. All right. And another one is like the level of disorganization, of apathy of the remaining shareholders. So they don't always vote together. There is no organization of their voting rights. Sometimes they may have. But in the case they don't have, and your voting rights, you don't need to have 50% to have your say matters. Okay? And also, if you have some other existence of contracts, that gives you power by agreement with other investors. So sometimes the other investor may just delegate you to vote. Then you don't need to have 50% to have your say, right? So those factors all need to be considered. Another one is the potential voting rights. Like if you maybe just have 30%, but you have the options. We do learn a little bit options in the previous lecture. So the options will give you the rights to buy shares. If your option may give you 20%, give you the rights to buy another 20% of the shares, and you can exercise those rights anytime. So this will give you the voting rights too, right? So those factors need to be considered when we are making judgment of the control. Why do we care the judgment of the control? Because the control will matter for us to determine whether this is business combination. If you obtain control, you need to prepare the consolidated financial statements. All right. And Again, let's come back to this concept of control. So it talk about the existing rights. So we understand more than 50% most likely will give you the voting rights. And even you have less than 50%, you will also possibly have the voting right. Depends on a couple of factors like the attendance at AGM, the dispersion, and the level of disorganization, blah, blah. So those will decide whether you have the existing rights or not. And those rights will give you the current ability to direct the relevant activities. What could be the relevant activities? The standard gives us a list of activities like selling and purchasing of goods and services, managing financial assets, selecting, acquiring, disposing assets, researching, developing new products. So those activities, they are significantly affecting the returns. As long as they are the activities that may significantly affect the returns, they are the relevant activities, right? Then we need to see okay, before we see that, we see this quiz, yes. So, sorry, I should delete these answers over there, but that's okay. I'll just give you, okay, clear results. Okay. I'll give you 1 second to read, then I'll discuss each of them. Okay, in determining the existence of power, together with size of the investor's voting interest, the following factors need to be examined in relation to the holders of the other shares in the investee. So basically, this is about what we discussed as the voting rights, how much voting rights you need to have so that you can have that existing rights to direct the business, to direct the relevant activities. Okay, so the first one, attendance at annual general meeting. So if you have less attendance rate, then you most likely will have the voting rights, though you don't have more than half of the voting rights, right? That's the one we want to see. That's the factor we want to consider. The second, the level of dilution and disorganization or apathy of the remaining shareholders. Yes, this is a factor. If the other existing shareholders are highly diluted, disorganized, then you are most likely when you have a large share, you most likely will have the say, right? And if there is some other existing contract which gives you the rights, then yes, you may also have that. So all of the options above are correct. So the last one would be the answer. All right. Yes. So ability, the power should be the ability to direct, right? To direct. So what could be the ability to direct? So those rights should be substantive. The holders must have the practical ability to exercise the rights. You might be a little bit confused. What is the substantive rights and what are the practical ability to exercise the rights, right? So substantive means at least they are not protective. They really mean it. So the standards provide some factor to consider in determining the existence of substantive rights. For example, whether there are any barriers, economic or otherwise, or legal or whatever barriers, which will make your ability to exercise the rights not feasible, not practical. Okay, so it makes you unlikely to exercise those rights. Then you probably won't exercise the rights, then you don't have the power. For example, they may give you some boundaries. Okay, if you have the rights, you have the voting rights, but if they say whenever you vote on that, and they need to have some specialized service to make sure that rights can be exercised, but those specialized service doesn't exist, then you wouldn't have that rights. Okay, that's not the practical ability to exercise the rights. Okay, so like also if let's say you do have more than 50% of the voting rights, but if you, yes, let's say if you have 30% of the voting rights and you have another 21% of the option, you can exercise the 21%, or you can exercise your option to obtain 21% of the shares, then you would have 51%. That looks like you would have the substantive rights, right? However, if you don't really have money to exercise those options. You know, when you exercise the option, you need to purchase the shares, and you don't have money to purchase those shares, then you don't have the practical ability. Is that okay? So that it would be also the financial barriers that would be preventing you from exercising your rights. So then you wouldn't have the substantive right, okay? And also, when more than one party is involved, whether there is a mechanism in place to enable those parties to practically exercise right, that will be also the case. Let's say if you have one party, but there are some other agreements you have to agree with before you can exercise rights, then your right may not be practical. All right, and so those might be the cases which doesn't give you the substantive rights. Another cases doesn't give you the substantive rights would be like the protective rights. So if the rights are purely protective, the holder doesn't hold the power. What are the protective rights? The protective rights, just like, you know, when we have the control, we may not hold 100% of the company's share. Let's say the controlling party only hold 80%. Then there must be 20% of the control, or not the control. Control can't be shared. You hold this company 80%, you control. Another minority hold the shares, 20%. If to protect them, there are some protective rights, say, before you do something, you must have this 20% with you, then that's only protective rights. Then that doesn't count. Okay, that's not the substantive right. You add the 80%, you still have the substantive rights, okay? And another case would be like the lenders. So this, for this one, this 20% would be called NCI. You will hear that a lot in the following lectures. So non-controlling interest. So this one doesn't give you the substantive rights. What the rights they hold is only called protective. Okay? So this is one scenario where that's still, you know, the protective rights doesn't prevent you from exercising your substantive rights. All right. Another case would be just like the lenders. So, you know, the company has the shareholder, has the debt holder. So normally the debt holder will have the right to claim when the firm goes bankruptcy or get liquidated. So in that case, the lenders will seize the assets of borrower only in the event of default. But that rights of the lender would be just protective rights. That's not substantive. They don't direct your business for the relevant activities. So that's not substantive. So now you understand what is substantive, and that's different from the protective rights. Okay, so let's have a quick look at this quiz. I'll give you a minute to read. Since I can't see you, I'm not sure which one you selected, but the correct answer would be B. Alright, let's see. When deciding whether or not one entity controls another entity, so the controlling entity must have exercised its power to control. No, as long as they have the practical ability to exercise their right, that will be good enough. They don't necessarily to exercise their power to control. Alright? It's sufficient that the controlling entity has a capacity to control. Yes, as long as they have the capacity and their rights are substantive and they have the practical ability to do that, that's good enough. They don't really need to exercise their power to make sure they are controlling. As long as potentially they are there, that's good enough. All right? And the controlling entity must be actively involved in the decision making. No, they don't have to be actively involving because they might be just happy with what the management are doing, why they want to exercise the right. Alright, okay, they just happy, then as long as they have, but when they are not happy, they have the capacity to do whatever they want. That would be the power they have, right? So C is not correct. And D, the controlling entity must have exerted its control. No, they don't necessarily to exert their power, but they need to have the capacity to exert if they wish. All right, so the answer is B. Yes. So another concept, like I said, there are three elements of the control. We need to have power. We need to have the practical ability to use the power to affect some returns. What kind of returns? That's the variable returns. So these are the three elements of the concept of control. So the returns to the investor must have the potential to vary as a result of the performance of the investee. So that's what we call the variable returns. You may think about the variable returns as the dividend because the dividend could be varying a lot, right? However, some fixed interest payment, some fixed performance fees can also be treated as the variable returns in the concept of control. Because, for example, the interest payment you is promised for a bondholder, but this bondholder are also exposed to credit risk of the issuer of the bond, right? So if they're exposed to the risk, the interest, whether or not they can receive the interest revenue, would be questionable, right? So that one we deem it as the variable returns. The controlling party would have the ability to affect such fixed return because they may run this business badly and the business just can't pay back what the debt holder should have. Okay, then this one, though it looks like in the form of fixed interest, but that could be variable, could be varying as well. Okay, so as long as they have the ability to affect such returns, then we will say that is the control. Okay, and the fixed performance fee for management could be varying as well, because they will expose the investor to the performance risk of the investee. All right. One thing I need to pay attention. So sometimes the block shareholder, they hold a lot of the voting rights. They probably don't want to exercise the control by themselves. They may delegate some agents. When they delegate the agents, that agent could be a company, all right? That agent could be a company. They delegate their voting rights to this agent. Then eventually, who holds the control? The agent or the principal? The one who delegates the agent to vote. So the agent wouldn't have the control when the principal delegates them to exercise the voting right. It would be the principal who still has the control. Why do we care who has the control? because it will eventually decide who will do the consolidated financial statements, right? The agent, if they are delegated the rights, they don't need to consolidate the subsidiary. But the principal who delegates the agent to do will need to do that. That's why we need to decide who has the control. All right? When we determine this is business combination and one party obtain control over another one, and we decide this is business combination, and we will have the acquisition method to account for the business combination. So the acquisition method typically involves 4 steps. First one, we need to identify who is the acquirer. Then we need to determine the acquisition date. Then we need to recognize and measure the assets, liability. If there is any non-controlling interest, we need to consider as well. And then we need to recognize and measure the goodwill or gain. You probably haven't understood this part. No worries, we'll do that soon in a second. Let's see the 4 steps of the acquisition method. So first of all, identifying the acquirer. Is that a problem? Is that a question? To be or not to be, is that a question? Yes, it could be a question. In most of the obvious scenarios, you would be able to identify the acquirer immediately, because the acquirer would be the party who obtain control of the acquiree. However, in some cases, they may not be so straightforward. So, for example, if the 2 companies, like let's say A and B, we have company A, we have company B, they combine and they generate a new entity, which is the C. So now it might not be that clear who controls who, right? So in this case, we do need to identify who would be the acquirer. In our courses, identifying the acquirer will be always obvious. I would not ask you to exercise the judgment to decide who would be the acquirer. So all the cases, it will be clear to you who is the acquirer. So you don't need to worry much, because identifying the acquirer could be complicated. Like in this case, if you have A and B combined and the C is newly generated, so it might be difficult to make judgment who will be the acquirer. Of course, there are some factors that will help you to identify them. For example, A and B, who is the bigger one? Normally, the bigger one might be the one to initiate the control. Then A might be the controlling party. Okay, but not necessarily. Sometimes the smaller size may come back to eat the bigger ones, right? So we don't know. This is just some factors for your consideration, but not necessarily the absolute determinants of this party who is controlling. All right, and who initiated the acquisition? Normally, the one who initiated the acquisition would be the controlling party, but again, it might not be the case sometimes. And who provides the consideration to another one? So normally, the one who provides consideration would be the acquirer, and another one who accepts a consideration would be the acquiree. But again, that's not all the time the case. For example, you may have the reverse acquisition. What is reverse acquisition? Mostly it will happen with the listed company and an unlisted company. Sometimes the listed company may not running that well, and the unlisted company want to get listed in some stock exchanges. but it might be difficult for them to meet the criteria to be listed. They may simply to buy a listed company so that they can become listed. So basically the listed company would be the shell company. You probably heard about that. They buy the shell company, and they will become listed. In such case, that might be the reverse acquisition. So it may not be the one who provides the consideration to become the acquirer. All right. So anyway, I will not ask you to make such judgment, but you should understand not necessarily. You should understand identifying the acquirer is not necessary to be very obvious. Okay, it may depending on a lot of other factors too. All right. So the second step is to determine the acquisition date. You may say, is that difficult? Yes, sometimes it could be confusing. When would be the acquisition date? Okay, first of all, I'll let you know the acquisition date is the date on which the acquirer obtains control of the acquiree. So the date obtain the control would be the acquisition date. But you probably should know during this acquisition, there could be many important events date. So those event dates could be like the closing date when the consideration is transferred. So on that day, the acquirer transferred their consideration to the acquiree. But this is not necessarily to be the acquisition date. The acquisition date should be the day they obtain control. If the date they obtain control is the same day as the closing date, yes, that would be the acquisition date. Otherwise, it's still about when they obtain the control, okay? And also, during the acquisition, there could be another date, like they have the major development in their discussion, negotiation, but those days will not be the acquisition date until the acquirer obtains the control of the acquiree. Why we are so fussy on this acquisition date? Because the acquisition date is very important, because we will need to assess many assets liability. We need to determine their fair value. Basically, the acquisition method is based on fair value. And the fair value could vary a lot. For example, I am an acquirer, and you probably will be the acquiree, and I offer you some stock, some shares I have. So in exchange of your shares to obtain your control. If I issue shares, and the share price would vary a lot, and also your share price varies a lot. So to determine the fair value, maybe just 2 days will make big difference for the share price, right? In such case, determining the acquisition date would be super important. All right, and of course there are some other assets, like the liabilities, the assets. We need to determine the fair value of them. So when we determine the fair value of them, the acquisition date is important. That's why we do care which day would be the acquisition date. So the fair value we need to determine are included here. We need to determine the fair value of net assets. Basically that could be the assets and liability, right? And we need to determine the fair value from the acquirer's part. That will be the consideration given. And from the acquiree, the whole assets and liability may not fully belong to the acquirer if they don't obtain 100% of the shares. They may have the NCI, non-controlling interest. And for the non-controlling interest, the fair value of that should be it should be deducted from what the acquirer can obtain, right? Because they didn't get that part. So the fair value of that is important too. And if the acquirer, so previously they may invested in 10%. Now they may invested in 50%. So in total, they will get 60%. If they have previously held interest, they will also determine the fair value of the previously held interest too. So in such case, we need to determine many fair values. Okay, so if we need to determine many fair values, determining the acquisition date would be important. Okay, that's the second step. Okay, let's have a look at this quiz. The acquisition date for a business combination is the date on which? Have a look, think about it. I think you should get it right immediately because I have repeated over 5 times of which date should be the acquisition date. The acquisition date should be B, on which the acquirer effectively obtains control of the acquiree. It might be a substantive agreement reached date, but it may not be, right? We don't know, but we need to make sure that date the acquirer obtains the control, all right? So A is not correct, B is correct, and the business combination is announced to the public. It might be the acquisition date, it might not be, because it determines on whether the acquirer obtains the control. D, the acquirer announces the acquisition to the acquiree. It doesn't matter. Okay, they announces the acquisition, but may not be the date they obtain control. All right, so we don't know. So the answer would be B, because that would be the date they obtain the control, and on that date we determine it as the acquisition date. Okay. Then the third step is to recognize and measure identifiable assets and liability assumed. You may say, why don't we just say the liability? Why we say liability assumed? Because sometimes they may have liability, but they are not shown as liability. So potentially they will have the liability. You may recall what we have learned in lecture 6. We do learn contingent liability, right? It's my question to you. Is contingent liability a liability? Do we recognize it in the financial statement as a liability? No, we don't. Contingent liability is just disclosed in the notes, right? If you can recognize it, that might be the provision, remember? So that's why we say the liability. But, we don't recognize the contingent liability in business alone. Right? So if the company has lawsuit cases, and that might be, there are a lot of uncertainty involved, they may not recognize it as the provision because they probably just don't have the certainty to recognize it, don't have the reliable way to recognize it. But they may disclose it as contingent liability. If they disclose in their own statement as contingent liability, when the firms become combined, there is the acquisition happening, then this liability could become the liability during the combination. In that case, we need to recognize and measure how much that would be. That's why we would say recognize and measure the liability assumed. Okay? So the acquirer measures each identifiable asset acquired and liability assumed at their acquisition date fair value. Okay, so this would be the recognition at measurement. It's possible for the acquirer to recognize assets liability that acquiree have not previously recognized. So in their own financial statement, they didn't recognize it, but during the combination, they probably have a more reliable measurement, then they would recognize and they need to assess the fair value of that. Yes, like I said, contingent liability, right? And the fourth step, once we finish the assessment of all the fair value of assets and liability assumed, then we do also know the fair value of what they acquire, the fair value of consideration that acquirer offered. Then the difference between them either becomes goodwill or the gain on bargain purchase. Because in the acquisition, the acquirer will compare the two things. One is the fair value of whatever they acquired and the fair value of the consideration transferred. Remember, we always, no matter that's indirect or indirect, we always compare the two things. The fair value of what the acquirer acquired and the fair value of what they offered for the consideration. Okay? So basically just like you purchase something, you pay a price, then you get the stuff, all right? And if there is any difference between them, so if the fair value of consideration transferred is higher than what they obtained, do you think they have loss or gain? Yes, they pay more than they get. Normally that would be the loss, right? But in combination, we don't recognize them as loss. We recognize them as goodwill. Why do we recognize them as goodwill? Because when you obtain a business, you obtain the integrated assets and liability of that business. You don't simply get a group of assets and liability, individually added up, right? We don't obtain that. We obtain the aggregated everything together. That's the combination of the assets and liability. Why would you like to pay more than what you get? Under combination theory, we believe that because the combination of that assets and liability provides some goodwill. That's why you would like to purchase more. Okay? So that's why we recognize it as the goodwill instead of the loss. Is that clear? So if the fair value of consideration transferred is more than the fair value of identifiable assets liability assumed, then you will recognize the goodwill. Okay? If it happens in the opposite way, if the fair value of identifiable assets and liability assumed is higher than what you offered, which is the fair value of consideration transferred, then basically you gain. You have a gain. If you have a gain, we recognize it as a gain on bargain purchase. The gain on bargain purchase. So this will immediately go to the profit and loss. Okay? So that will be the gain on bargain purchase. However, remember, whenever we recognize, yes, this one does go to profit in current period, but when we recognize the gain on bargain purchase, we recognize the profit. Remember, we are accounting, we want to be conservative. If we recognize the gain on bargain purchase, then we need to be conservative. Okay. I don't have that slide here. Have conservative. We need to assess everything again. We need to assess everything again. We need to make sure we don't overstate the gain. All right. After you re-examine all the fair values, all the comparisons, then you recognize the gain on bargain purchase. All right. So when this case happens rarely, how to say this case happens rarely, which means you really get a good bargain. It normally doesn't happen, but if it happens, it will just be re-examined. Then you can recognize the gain. And the fair value of consideration transferred would be just whatever you offered, the fair value of whatever you offered, okay? And this, if the consideration includes a payment contingent on a future events that is probable, you may also, and that could be measured reliably, you may also include it in the cost of acquisition, which should be included in your consideration. You may get confused about the contingent on future events. I'll show you in my second in the example. All right. So, yes, when we do business combination, we would have the acquisition-related cost. Those costs could be directly attributable to a combination directly attributed to a combination, but we don't include it into the consideration transferred. Rather, we will just expense them as they occur. Okay? So you may be confused again. For acquisition-related costs, we always have say directly attributed costs should be capitalized. Why we expense them here? The case here, we don't want to put them into the consideration transferred because consideration transferred is exactly the consideration transferred to the acquiree. If they are not transferred to the acquiree, they shouldn't be considered into the consideration transferred. Okay? Again, to be clear, the consideration transferred is always the consideration transferred to the acquiree. If that's not transferred to the acquiree, they are not included in the consideration. Okay? They will, though they might be directly related to this business combination, like they may hire a lawyer, they may hire some assessor to assess the fair value, they may hire some accountant to do this, to help them with the transaction, they may involve the stamp duty. Those looks like directly attributable to this combination. But during the combination scenario, they will be just expensed. Okay? Be clear, they will just expensed. They will not be treated as part of the consideration transfer. I'll show you an example in a second, so don't worry much if you haven't got it clearly. Okay? So let's look at this quiz first before we see the examples. Okay? I'll give you a second. Okay. Where the acquirer purchases assets and assumes liabilities of another entity, it doesn't need to consider the measurement of A, consideration transferred, B, fair value identifiable assets, C, carrying amount of identifiable assets, D, goodwill. Which one have you selected? Remember what we do. We always do the comparison between the fair values. The fair values of identifiable assets and liability assumed, and the fair value of the consideration transferred. The difference between them would be either goodwill or gain on bargain purchase. So A, B, D, are all the ones we need to consider. C is carrying amount of identifiable net asset. Carrying amount, no matter how much it is, we don't care. We will do the fair value assessment, then we will determine the fair value of identifiable assets and liability. Okay, so C is the one we don't need to consider. You get that right? Hopefully. Okay, let's see this one. I'll give you a minute to read it. The consideration transferred in a business combination is measured as fair value of the A. Net assets acquired, B. Costs directly attributable to the combination, C. Consideration given, D. Consideration given plus directly attributable costs. So basically, answer C, consideration given, is just interchangeably used as consideration transferred as well. So the answer should be very straightforward, C. Okay, so it is the consideration provided, consideration given by this acquirer. All right. And D would not be right because we have discussed it. We have discussed the consideration given, the directly attributed cost should not be included in consideration given. All right. And B, the same, cost directly attributed to the combination shouldn't be included. All right. And the net assets acquired, that's really coming from the acquiree side. Okay, we compare the consideration provided with this net assets acquired. Okay, so the answer should be C. Okay, look at this one. I'll give you a second. You probably need 1 or 2 minutes to calculate. There is a little bit of calculation. So basically here we are do the comparison between the two fair values, the fair value of net assets acquired and the fair value of consideration transferred. Okay, so Frederick acquired identifiable assets and liability from Nico for 134. So this is what they acquired. That's the fair value of net assets. Okay, and what they acquired, they very limited. Okay, for this amount, that's the consideration they gave. All right, the consideration the acquirer gave, and here are the items acquired. Yes, here. What are they? They plant 72, inventory 40, accounts receivable 18, patent 10, account payable 16. So there are assets and liability here. What we do, we simply add them up, see how much is the net asset. Okay, Plant 72 plus inventory 40, that's 112. Account receivable 18, that's 130. Patents 10, that's 140. Account payable less account payable 16, that should be 124. So 124,000 is the net asset, the fair value at net assets. And what they offered is 134. So the difference between them would be 10. That 10,000, would that be goodwill or gain on bargain purchase? 10,000. So let's see. The consideration transferred is 134. And the fair value of net assets acquired is 124. So the consideration is greater than the net assets. So they pay more. Then they didn't get gain. All right, they should recognize, not loss, the goodwill. Okay, that's the goodwill of 10. The answer should be C. All right, the answer should be C. Yes, now let's look at the examples. All right. So this is the calculation of consideration transferred. We do need to know the consideration transferred. Remember that. This would be the, let's say, that's the steps in, that's one of the acquisition method, but that will be the very beginning of consolidated issues. So you need to make sure we always know how to calculate the consideration transferred and the fair value of net assets. Otherwise, you would get big troubles with the consolidated issue because that's the very, very first step of consolidated issues. Okay? So this is just the fundamental basic ones for the following lectures. So make sure we do understand those. All right? Okay, let's look at the question. So A acquired all assets liability of B, and the consideration transferred are as follows. We need to determine the fair value of consideration transferred. Okay, cash. That's easy. Cash is cash. 400, but half to be paid on the 1st January and half to be paid. 1st January 2012 and half to be paid next year. The incremental borrowing rate for A is 10%. What does that mean? Half of them to be paid today, that will be just the cash today. But half to be paid for next year. Do we have time value of money? Yes, we do need to discount it, right? By 1 year and 10% interest rate. Okay, we do need discount it. So these two added up would be the cash offered. What else? 100,000 shares. 100,000 shares. And the share price today is 1.5. So that's 100,000 shares times 1.5. That will be the shares they offer. Yeah, but there is another thing. The price represented a 6-month high, so we don't know whether the price will be dropped. Okay? The cost of issuing the share was 1,000. How shall we deal with this 1,000? The cost of issuing the shares, is that part of the consideration transferred? No. The consideration transfer should be the consideration transferred to the acquiree, and this cost is just the expense for issuing the shares. So they are not part of the consideration transferred. Okay, so we shouldn't include it. So from this part, we have 100,000 times 1.5. So added up to the previous two items. Then next, due to doubts as to whether the share price would remain at or above 1.5, A agreed to supply cash because this is 6 months high, right? They're not sure whether this one would remain or maybe go higher. So they agreed to supply cash if the value of any decrease in the share price below 1.5. The guarantee was valid for a period of 3 months. So today is 1st January for 3 months. So if that's at the end of the 30th March, Then 31st of March. Yes, then the A will do some compensation to make sure they can still have the value of 1.5. How do they do that? A believed there was a 75% chance the share price would remain at or above 1.5, so they don't need to pay anything. But a 25% chance it would fall to 1.4, sorry. So if that dropped to 1.4, they will have to make sure they money would be reach 1.5. So they will have to pay 10 cents to make sure they get 1.5 for the shares that is 10,000. This would be the contingent future event. Remember what we discussed in previous slides? The contingent events, because it will be depending on the future performance of the shares, right? But this price should be borne by the A company, the acquirer. Okay? So the likelihood is 25%. So this price should be, they need to guarantee, so there is a 25%, they will have to pay 10 cents for the 10,000 shares because they guarantee the share price would be 1.5. So this one, contingent on the future performance, it has to be considered into the consideration. Okay? And they also have the patent to be. The patent fair value is 60,000. So this 60,000 should be recognized. Though this one is not internally recognized in A, but it has the fair value during the combination, you can recognize it. So we add all the things up, that will be the consideration transferred. Okay, there's another item. Legal fee and associated with the transaction would be 5,000. Shall we include that into consideration? No. Even though that's directly attributable to the acquisition, we don't include it into the consideration transferred because that's not the consideration that the acquiree is going to receive. Okay? So we just add up all the things we have discussed. So 200,000 cash, half of that. Another 200 have to be discounted. And the shares 1.5 added, and another 10 cents has to be paid for the 25% chance. If that price dropped and there are 25% chance it will be dropped. You may say this happens in 3 months time. Shall we discount it as well? Yes, you can. But thinking about the trivial value of that, that's a small value. We don't need to bother to do that because it doesn't make much difference. All right. If you do discounting, that doesn't get you lose mark. If you have an exam, it shows this discount over here. It will be clearly specified whether you should discount it or not. Otherwise, you can just do the direct. You don't need to consider the time value of money. All right. Then we include the patent, then that will be the total cost of acquisition. We don't need to consider all the other directly attributable costs. All right. So this one should be quite straightforward. We should have no problem with that at all. Okay. Then, yes. So for goodwill, recognizing and measuring the goodwill or gain on bargain purchase. This is the 4th step of the acquisition method. Then for the direct acquisition, basically for the direct acquisition, the acquiree will cease their operation. The acquirer should just recognize the goodwill in their own account. And for indirect one, both of the acquirer and acquiree will continue their operation. So the acquirer will recognize goodwill in their consolidated accounts. Okay? And let's calculate, see if we have the goodwill. So this company acquired for cash all the issued share capitals for the amount. What is this? Acquired for cash of all issued share capital, 100%. So this would be the consideration. Okay, consideration. On that date, the assets liability, contingent liability of the acquired of another company, this is the acquiree, are as follows. Let's have a look. They have cash. The cash always have the fair value as their carrying amount, right? And they have accounts receivable, they have inventory, they have land, they have plant, they have blah, all these things, okay? Do we care the carrying amount? We don't care here, okay? What we care are the fair value over here, okay? So we simply do all the fair value added up. Is that very straightforward? Yes, and less the loans, less the liabilities. And see what the additional information says. The additional information says this company, acquiree, is currently being sued by previous customer. Expected damage is this much. Lawyer estimate a 20% chance of losing the case. So the young actually would just not recognize it, just disclose it as a contingent liability. But when they are combined, they are acquired by another company, it has a fair value. The fair value should be just 230. This is estimated damage, but the chance is just 20%. So this would be the contingent liability, should be deducted from the total amount of the total amount of the net assets. Okay, so that should be very straightforward. We simply add them up, all of them up, and also less the contingent liability, less all the liabilities. So all the assets add up, all the liability deducted. So eventually we get the fair value of net assets acquired as 600. We compare two things, remember, the fair value consideration transferred and the fair value of net assets acquired. The difference between them is 50,000. Okay, so consideration is higher than the fair value of assets acquired. What is that? If you offer more, we will recognize the goodwill. Okay, so we will have the goodwill recognized here. Okay, goodwill on acquisition date. Yes, sometimes you may have this gain on bargain purchase. Again, like I mentioned here, if there is gain on bargain purchase, you need to be cautious whether they are true or not. So you reassess everything, then you recognize. Okay, after your reassessment, if they are still there, you need to recognize. Okay, and there would be involving subsequent adjustment to the initial accounting for business combination as well. So, like goodwill, what we have learned for goodwill. Goodwill would be subject to impairment test. If there are impairment happened, we need to recognize the impairment loss to the goodwill, right? So the net value of the goodwill would be the goodwill less the impairment loss. Okay. And the goodwill impairment test prior to 2005, the standards required the company to amortize this goodwill systematically over the periods in which the benefits were expected to be provided, but the period could be, the maximum length of the period should be 20 years. Okay, that's the previous standards. Now it's changed. You know, now the acquirer has to test it for impairment annually, every year. Remember, we do learn this in the impairment loss, so we need to test it for impairment annually. Or more frequently, if the events or changes in circumstances indicate that it might be impaired, then you need to do more frequent impairment test. The impairment loss should be just accumulated into the goodwill. So the net goodwill would be goodwill originally recognized less the accumulated impairment loss until it's 0. Yes, then, yes, we would have the consolidation issues. The consolidation issues, first, we are not going to touch the very technical part in this lecture. I will just theoretically or conceptually explain what could be the consolidation and under what cases we need to do the consolidated financial statements. So basically consolidation is very important. That's why we have to learn it, though it's very hard, but we got to learn that, okay? So why it's so important? Because many companies are a group. So they are groups of individual entities. If you look at Woolworth, yeah, we all know Woolies, right? If you look at their financial statement, you will realize how many entities are in their financial statements. They actually have over 100 subsidiaries. Okay? So they have, but if we simply disclose the parent company, that doesn't reflect the real economic performance of this company, because their performance will be largely influenced by their subsidiaries, right? That's why we have to do the consolidated financial statements. Consolidation basically is just the process of combining all the financial statements of individual entities under the control of one entity. So you combine all the financial statements of whoever you are controlling, then you get the consolidated financial statement. The process to get these consolidated financial statements is the consolidation. Okay, so now we have several key terms. That's the group, the parent, and the subsidiary. Who is the group? Group basically comprises of different legal entities. It's also known as the economic entity, which would include the parents and all its subsidiaries. Okay, in one group, there could be only one parent. The parent would be the entity that controls one or other more entities. And subsidiary would be that just the legal entity controlled by another entity. And in one group, there can be only one parent, because the control can't be shared. Control is control. It can't be shared, okay? Let's have a simple look, okay? This would be just the very simple parent and subsidiary relationship. So they two together is one economic entity. But these two are two separate legal entities. One controls another, and the one controlling is the parent. Another one is just a subsidiary. Okay, this is just simple, and they two together would be treated as one single economic entity. But they two actually are two single legal entities. All right. But why we need to consider them as the one group? I'll just give you one very simple scenario. All right. Think about the company. The company A as a parent. Let's say company A sells something to B and get $100,000 profit to B. Okay, $100,000 to B. And they sell something to B. Then if we just disclose A, as a single entity, we would see 100,000 profit in A. Yes, shall we see that? Yes, we will see A performed very well. It has $100,000 profit. But B is here. If B doesn't sell that product to anybody else, that stays with B. Do you think this 100 profit from the group perspective is realized or not? The B holds their stock maybe for 2, 3, 5, whatever years it holds. Okay? Now basically, this 100,000 profit isn't realized from the group perspective. Do we agree? A probably just sell that to B for the purpose to get 100,000 profit, to get rid of some idle products. If so, the profit is not realized because it's not to external party outside of this group. Okay? We need to, if we want to see how well A the group is really performed, or A is performed, this 100,000 actually is not counted as profit because it's not actually realized. So we need to do something to eliminate this 100,000 until that 100,000 is really sold to another party outside of the group. Otherwise, that will be just an overstated profit for the group. Is that okay? So that's why we need to consider this as a group instead of each individual entities. Okay? That's very, just conceptually, you can understand why we need to do that. Okay? And another example becomes a little bit more complicated. So here we have the parent as George. So George has 100% control over Ted, Max, Fred. So basically, that is a group. And this group's parent is George. Okay, but you may think about here. How about here? The Fred and Rick. Fred obviously is controlling 100% of Rick, so Rick would be the subsidiary of Fred. Fred is the parent of the subgroup, right? However, remember, in one group, there is only one parent, okay? So George is the parent of the group. Fred could be the parent of this group, but not for the big group. Okay, Fred may prepare consolidated financial statement for their subgroup, but George will prepare the consolidated financial statement for the big group. Is that okay? So one big group can only have one parent controls all the others. All right? And what is the consolidated financial statements? Basically, that's just the financial statements of a group in which assets, liability, equity, income, expense, and cash flows, the parent and its subsidiary are presented as those of a single economic entities. Okay, that will be just consolidated financial statement. Those consolidated statements should reflect only the effects of transactions with external party to the group. Like I've shown you here, if you reflected the internal transaction, the intra-group transaction, it's just not the true performance of the group. It should reflect the transaction to external. Any internally generated one should be eliminated. That's the consolidation process does, okay? Consolidated statement, how do we prepare them? We do basically two things. First, we aggregate. Second, we adjust. Okay, we have two sets of statements. We have the parents' financial statements. We have the subsidiaries. Okay, let me say something to you before I do this. The one parent, as I show you here, could have multiple subsidiaries, okay? Subsidiaries could have subsidiaries, so a group consolidated financial statement could be complicated. However, let me tell you, we are not doing something that complicated. We are very nice. We just give you the simplest scenario, which is one parent, one subsidiary. Okay, we only do that. We don't even consider another subsidiary. Are we nice enough? Yes, I think I am. Okay, anyway, yes, we have one parent, one subsidiary over here, okay? Then we combine them. Okay, if you look at the balance, let's say this is the balance sheet. Okay, we have assets here, assets here, assets here. We have assets, 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 liability, 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 liability. Okay, what we do, we simply add them up line by line, line by line. Is that okay? Then that's the group. Is that simple? Beautiful. If it's so beautiful, okay, we would be laughing at it all the time. However, it's not so simple. Okay? We do first aggregate them, we add them up line by line. Second thing we do is do the adjusting. we do the adjusting. So adjusting would be those combined figures for intra-group transaction between entities within the group. Because if we simply add them up line by line, we just overstated many things. The simple example, just as I have given as the profit of 100,000. Actually, that 100,000 is not realized. If we add them up line by line, we would have that profit. However, that profit isn't realized, so we need to adjust that profit. How do we adjust? Depends on how much the subsidiary has sold to external parties. Okay, so the technical part we will discuss in the following lecture, not in this one. But now you need to conceptually understand what we are doing for the consolidation. Alright, you need to understand we do two things, we aggregate, then we adjust. Alright. The consolidated financial statements are prepared by the parent, in addition to its own financial statements. So if you look at a parent financial statements, you will see two things. You will see the parent itself as an entity, then you will see another one is called consolidated financial statements. Okay, it should be prepared by the parents. Okay, let's see this quiz. The consolidated financial statement reflect the effects of transaction A, between internal parties to the groups only, B, with external parties to the group only, C, both between internal parties and with external parties to the group, D, with some internal and external parties to the group. Which one? Both internal and external? No. Both between internal and external? Are they the same? No. With internal? No. So that should be only reflect to external. So the answer should be B. Okay? When we do this, why we do the consolidated financial statement, I've explained a little bit, because this one will supply relevant information to investor. Otherwise, it's not truly reflecting the company, the entity's performance, right? If you only look at the parent itself doesn't say much, because the parent's performance would be highly relying on the whole subsidiaries, the whole entity's performance. So that's why if we purely supply information for the parent, it will not be relevant for the investor to understand, to make their decisions. All right, it has to be for the groups that controlled by the parents. Okay, and it also allows comparison of the group within with the similar entities. If group A and group B, so if you just compare Woolworth parents company's performance with Coles parents companies, it doesn't make sense, because they both all heavily rely on their subsidiaries' performance. So if you just purely pick up the two parents, it doesn't make sense. You need to see the two groups' consolidated financial statements so that you understand how the two economic entities do. All right. And to assist in the discharge of accountability by management of the group, again, the single parent's performance doesn't say much of the management performance, because the management is really managing, because they have the power to direct all the relevant activities of the subsidiary, right? So they should be accountable for the whole group's performance. So if you only look at the parents, if you only look at the management of the parent's company, it doesn't say much. You need to look like the management of the whole group. Of course, the management stays in the parent, but actually they are managing the whole group, right? So it will assist in the discharge of the accountability by the management of the group, and also report the risk and benefits of group as a single economic entity. Okay. A parent normally will be required to prepare consolidated financial statement. So normally, every parent needs to prepare consolidated financial statement. In some circumstances, they are not required. Only under some specific circumstances, they don't need to prepare consolidated financial statements. And they need to meet all of the following conditions so that they can be exempted from preparing for the consolidated financial statements. Okay? So what are those circumstances? First, if this company is a wholly owned or a partially owned subsidiary of another. So basically, the company, if you look at the picture I give here, okay, so Fred is a subsidiary of Greg. Fred is a parent. Can we see that? Fred is a parent of Rick, right? If you are a parent, you should prepare for consolidated financial statements, right? But Fred might be okay if it first meets one condition that George is a parent. So it's wholly owned by George or partially owned by George. That's the first condition. So first, it will be owned by another parent. It is a subsidiary of another entity, either wholly owned or partially owned. If wholly owned, its parents says, okay, you are okay without preparing for the consolidated financial statements, yes, that is okay. If it's partially owned, then this other non-controlling parent also need to say, yes, you don't need to prepare. Then this one doesn't need to prepare. Is that okay? So either this one is wholly owned or partially owned. Anyway, it's a subsidiary. It is a parent of another of its own subsidiary, but it should be the subsidiary of another entity. And if all the parties, all the other owners agree for this company not presenting consolidated financial statement, yes, it passed the first criteria. Okay? And is not traded in the public market. So you don't issue debt or equity. It's not listed company. And if it's not about to issue any instrument in the public market, so you don't really want to issue debt or equity in the public first of all, you are not traded, not listed there. Second, you are not issuing any new debt or shares. Then your ultimate or any intermediate parent produces consolidated financial statement. So you are fine. Okay? So you are not listed, you are not issuing the new instruments in the public market, and you are the subsidiary of another company, and your parents are preparing for the consolidated. Then you are fine without preparing consolidated financial statements. Is it okay? I'll show you in another figure too. And the condition 4 could be exempted in some circumstances. If the condition 4 is not met due to the effect of Australia's reduced disclosure regime requirement that this one is the parent is not a reporting entity and the parent don't need to prepare the consolidated financial statement. In that case, you are also fine without preparing the consolidated financial statements. Because condition 4, what does condition 4 says? Condition 4 says your parents need to prepare consolidated financial statement. Then you are exempted from preparing. However, if your parents is under this disclosure regime, reduced disclosure regime, and exempted from preparing, then that's okay. If your parents doesn't prepare, and you don't really need to meet this condition to make sure you are exempted from preparing consolidated financial statements. Okay? Otherwise, they need to prepare. Okay? I'll show you this figure, then we will finish. All right. Okay. So, yes, what we are talking is about entity B. Okay? Entity A needs to prepare for financial statement. Consolidated financial statement, because obviously A is a parent of the whole group. Okay, and A is not anybody's subsidiary, so A would need to prepare for consolidated financial statement, except for the situation where A would be exempted from the two-tiered reduced disclosure regime. Otherwise, A need to prepare. Okay, our focus here is the discussion on B. Okay, we don't care A. Let's see B. Because B has subsidiaries over here, then normally as the parent of this group, B needs to prepare for consolidated financial statements, right? Normally it needs to. However, because B is also the subsidiary of A, it means condition 1. So if this company is a subsidiary of one parent of a group, it could be exempted if it also meets another 3 conditions. Okay. Second condition, the B isn't listed in any stock exchange. If B is an unlisted company, that might be fun. If B doesn't have the issuance in the debt or share or any financial instruments in the public market, that might be fun. And the 4th condition, if B's parents is preparing for the consolidated financial statements, which is A is preparing for consolidated financial statements, it meets all the 4 criteria, B is exempted from preparing. Okay? So, yes, it needs to meet all the 4, except for the condition 4 that A might be subject to the two-tier. Okay, two-tier. Reduced disclosure regime, and A is not required to prepare for. And B meets all the 3 conditions, then that's okay. B is exempted from preparing. Otherwise, if B doesn't meet the 4 conditions, the B needs to prepare its own consolidated financial statements for this group as well. Okay, so A is holding 90%. If B also has another owner holding 10%, and this 10% also need to agree B to say, okay, that's part of the condition 1, right? If NCI 10% holder says, okay, you are fine without preparing, then B is exempted. If B meets all the conditions here, but NCI says you need to prepare, then B still needs to prepare. Okay? So that's all the conditions it needs to meet. Then B is exempt. So now you understand who needs to prepare the consolidated financial statements. Okay, basically every parent needs to do that except for the parent who meets those criteria. Okay, so that's all for today. Make sure you do read them, you do listen to the recording before your next lecture. Otherwise, you will be lost. I can guarantee you that. Okay, good luck with everything you are doing and have a good day.